Hello, hello, hello. This is Gresh from the I Am CEO podcast, and I have a very special guest on the show today. I have Paul Moore of Wellings Capital. Paul, it's awesome to have you on the show.
Hey, it's great to be here. Thanks, Gresham.
No problem. Super excited to have you on. And what I wanted to do is just read a little bit more about Paul so you can hear about all the awesome things that he's doing. And after graduating with an engineering degree and then an MBA from Ohio State, Paul started on the management development track at Ford MotorCompany in Detroit. After 5 years, he departed to start a staffing company with a partner. They sold it to a publicly traded firm for $2.9 million 5 years later. Along the way, Paul was the finalist for Ernst Young'sMichigan Entrepreneur of the Year 2 straight years. Paul later entered the real estate sector where he completed 85 real estate investments and exits, appeared on HGTV Special, rehabbed and managed dozens of rental properties, developed a waterfront subdivision, and started 2 successful online real estate marketing firms. 3 successful developments, including assisting with development of Hyatt Hotel and a multifamily housing project, led him into the commercial investment arena where he manages 2 private equity firms. Paul, are you ready to speak to the I'm CEO community?
I am ready. I'm
Awesome.
Exhausted, though, after that long bio, man.
Exactly.
Like some shiny objects in there, doesn't it sound like?
Exactly. I can't imagine how it was doing it. It was a lot of reading it. So I know you're rocking and rolling, doing a lot of awesome things. So it's great to have you on the show.
You bet.
Yes. So I wanted to kick everything off and hear more about what I call your CEO story and what led you to start your business.
So, when I worked at Ford MotorCompany, it was almost, 20, 30 years ago almost. Man, I could have retired. I really liked Ford, and like a lot of people have these complaints about the big company they work for or whatever, but I actually had no complaints. I really liked it, but I looked at the potential career path and I saw that a lot of executives were, transferring all around the country. Their kids never got to have roots anywhere. I heard of some kids who said that they told their parents back around, 10th or 11th grade, look, I'm not moving again, Dad. I'm staying here. I'm going to move in with my friend. And I didn't want to see that happen. So I also found myself tinkering with stuff. My buddy and I were always doing things in the evenings and weekends, trying to start some side gig, to make money on the side. And so I realized, I think I'm more set to be an entrepreneur than I am work at Ford for the next 30 or 40 years. So we launched out on our own. And, my wife was amazing because she is super risk averse. She hates risk. But she actually let me take this risk, even though she was 7 months pregnant with our first child.
Oh, wow.
And she hated the thought of, we didn't even know any entrepreneurs. So she hated the thought of all that risk. But, thank God for her that she let us, she let me launch out and gave me the freedom to do that. And so there's been a lot of ups and downs along the way, let me tell you.
Yeah, I bet so. And especially, like you said, you didn't have like any entrepreneurs around you. So being able to kind of see that path and do it anyways, that to me is the real definition of like a trailblazer.
Yeah.
Yeah. So yeah. I guess, could you tell us a little bit more on like what you decided to launch? Tell us a little bit more about Wellings Capital and everything you're doing.
Yeah. So after doing that company, I in 1997, I found myself before my 34th birthday. I actually found myself, going into so-called semi-retirement. And I thought, well, I'm an investor now. And, I really didn't know the first thing about investing, Gresh. I thought I didn't understand the difference between investing and speculating. Investing is when your principal is generally safe and you've got a chance to make a return. But speculating is when your principal is not at all safe and you've got a chance to make a return. And I was definitely speculating and calling it investing. And so I made a lot of money on some things and I lost a lot of money on other things. And that's one of the reasons we launched the podcast we have today. It's called How to Lose Money. And that's where we talk to successful entrepreneurs and investors about mistakes and things in their past on their road to success where they got burned or lost a lot of money. But at any rate, I got into flipping houses before flipping was a thing. And then we actually started buying and reselling waterfront lots, built a small subdivision, built some houses from the ground up. And like I said, I made some money, lost some money. And I realized when I turned 50 that I didn't want to be on the losing end of some startup, or some risky speculative venture. I didn't want to be on the, it's like the double or nothing. I didn't want to be on the nothing part of that
Right.
someday in my 50s, 60s, 70s, whenever I couldn't work again. I didn't want to leave my family stranded. And I thought, what could I do? What could I do that would be risk averse, that would be, I wouldn't be swinging for the fences. I'd actually be, trying to hit singles and doubles. And I discovered that in commercial real estate. And, Gresh, I found out that almost all the Forbes 400 wealthiest people in America are investing in commercial real estate. A lot of them got there through commercial real estate in the first place. And I realized there's a reason for that. And when I discovered how commercial real estate really works, how the value formula works, et cetera, I have never looked back since then. That's why we launched Wellings Capital.
Nice. I absolutely love that. And I love the fact that I always say success leaves clues. So the fact that you mentioned that the people on the Forbes, 400 or Forbes 500 are somehow associated with, commercial real estate, you understood that that was something that not only did it fit within what you were trying to accomplish, but it also could lead you on that path and could lead many others on that path, it sounds like.
Yeah, that's very true. It's surprising to me that, and I could go through the math if we have more time, but if you can save $1 a month at a commercial real estate property, if you can make an extra dollar or save $1, you add $1 to your income, that's $12 a year. And you divide that amount by the cap rate, which is the rate of return. And let's say that's 6%. That's the general rate of return in a certain asset, certain property, like a certain market right now. $12 divided by 0.06 is $200. So I can create $200 in value at an asset, whether it's multifamily, self-storage, mobile home parks. I can create $200 in value to the shareholders by adding $1 to the bottom line. It's pretty powerful. Now you take that and multiply that out times, the thousands of dollars you can actually create. We're talking real money here. And with leverage, when you take debt into the equation, it even multiplies that effect further. And so it's there's all kinds of examples in this if we have more time, but it is a powerful lever that commercial investors and operators can pull to really create real big wealth.
Nice. Yeah, that definitely is huge because, to be able to simplify it on that level so that everybody can understand. But like you mentioned, if you have more leverage, then of course you can multiply and set that, that equation on fire, so to speak. So I appreciate you for sharing that with us. And now I wanted to ask you for what I call your secret sauce. And this could be for you or your organization, but what do you feel kind of sets you apart and makes you unique?
So what we're doing is there are a lot of people, some of them, there are some newbies out there who were not investing in real estate in the last crash, and they're now experts. They've got mentoring programs, they're selling coaching, and they haven't lived through a crash, and I will say that, we've been through a couple crashes, the minor one in early, like around 2001, and then the big one, of course, that we all know about. And I can say that we have gone to great lengths, we're in our 50s, to vet operators, and we are able to find great operators and put them together and make their products, their investments available to investors. And so Wellings Capital has got two funds. We've got a growth fund, which is all about appreciation, and then an income fund, which is income and growth. And we've put together a diversified group of these amazing operators who have survived and actually thrived through more than one recession and who have great returns, and some of them are not really well known to the public. We're making them known to our investors and giving investors an opportunity to invest. And they're actually giving us a better deal because of our size. And so we're actually able to do that at no effective cost to the investor. So that's what we love about what we're doing.
Yeah, absolutely. And I always say that, you always try to build upon the expertise of the people that are on your team or the people that are around you. And like you said, you guys have been through those, great economic times, but also the not so great economic times. And to be
Yeah.
able to kind of tap into that expertise and understand, how you're investing your money, how you're not speculating unless you want to speculate, but understand the difference between the two is really important to kind of do that if you're doing something like that.
Right. Right.
That makes perfect sense. And I wanted to switch gears a little bit. And I wanted to ask you for what I call a CEO hack. And this might be an app, a book, or a habit that you have, but it's something that makes you more effective and efficient.
Yeah, absolutely. So I tell you, CEOs, entrepreneurs in general are a very, let's say, an optimistic bunch. And so as optimists, we tend to believe, we tend to also get distracted easily. We tend to chase shiny objects. And, he who chases two rabbits
Catches none.
usually catches none. And there's another saying, I'm forgetting it already, but an acorn that is planning to turn into a large oak tree plans not to move around too much. I said that totally wrong, didn't I? But anyway, you get the point.
I get the point.
And so I found that over the years, one of the biggest mistakes I made is just chasing too many things at once. So I have begun a program with Jeff Woods and Gary Keller. It's called The One Thing. And a lot of us have heard of the One Thing book, but they've actually got a program. You can sign up for it. And they teach you, and they have weekly updates and coaching calls and accountability, helping you stay accountable to focusing on one thing and doing that really well. A friend of mine just ran for governor of Colorado last year, and he failed, but he said he was rubbing shoulders with very, very wealthy people. And he said, the difference between them and most of us is that they focused on one thing for decades, and they were not willing to be distracted by 10,000 things they needed to say no to along the way. And that's what I think I really wish I would have done better at that over the years.
Yeah, that's a great kind of hack, because a lot of times I always visualize, and I can't remember the quote myself, but it always talks about a magnifying glass. If you take a magnifying glass and you put it under the sun, it will burn a hole in a wooden plank. But if you take that same sun and you don't have the magnifying glass, it can lay on that plank the entire time and never make any impact. So it's so important to kind of be like focused and have that one thing. So I'm glad you brought that up.
Very true. That's good.
Yes. And now I wanted to ask you for what I call a CEO nugget. And you might have already touched on this, but this is something that is a word of wisdom or piece of advice. Or if you can hop into a time machine, what would you tell your younger business self?
Oh, absolutely. That's easy. I've told my son and my junior partner, they're both about 25 years old. And I said, knowing what I know now about commercial real estate, I absolutely never would have done anything else, because the risk and the return and the ability to see the demographic outlook for years to come is very, very powerful. Warren Buffett doesn't generally invest in internet stocks because he says, I don't know what the future of technology holds, but I do know that the internet's not going to change the way people chew gum. And so, Buffett would rather invest in gum than he would, an internet stock. And so I feel the same about commercial real estate. It's going to be here no matter what else changes in society. That's going to take different forms, but commercial real estate is definitely where I would recommend anybody look at if they're in their 20s or 30s looking to invest.
Yes, that makes perfect sense. And, who better to listen to than definitely the guru, Warren Buffett, especially. I know him talking about that, and also Coca-Cola as well, too, just understanding these are things that have lasted for years and years and years, just as you're, speaking to, commercial real estate has always been around because, you need a place to run the business and to, build your empire, I guess you could say.
Yeah, right.
Nice. And now I wanted to ask you my absolute favorite question, which is the definition of what it means to be a CEO. We're hoping to have different quote unquote CEOs on the show. So Paul, what does being a CEO mean to you?
I think it means being a servant and drawing out the talents of everybody in your organization. A CEO, they say we should rule like a servant and we should serve like a king. And so as a CEO, I want to do both of those well. I want to rule like a servant and I want to serve like a king. And in this case, I think drawing out the talents of everybody and giving them a chance. They say if somebody in your organization can do something 60% as well as you should consider delegating that thing to them. And so we're bringing along other people, and I genuinely hope that everybody in our organization ends up being super successful in their own right, whether it's with us or with their own company down the road. And so that's my heart in that.
Nice. I absolutely love that quote and that reminder, because it's important to kind of understand that when you are leading a team, and even when you have clients, you have to make sure that you are, building that service aspect, especially in it. So, Paul, I truly appreciate your time. What I wanted to do is pass you the mic, so to speak, just to see if there's anything additional you can let our readers and listeners know, and then how best they can get a hold of you and listen to your podcast.
I touched on it earlier. I said that, investing versus speculating is something that's really important for everybody. And I'll leave people with a couple quotes here on that. So Paul Samuelson was the first Nobel Prize winner in economics from the US. And Samuelson said that investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. And I think Samuelson's quote is so important because it reminds us that while we might want to get we might have fun, we might want to, live on the edge, we want to have excitement as a CEO, that's fine, like as an entrepreneur. But when it comes to investing, our investments should generally be very boring. And then the very last quote is from the wisest man who ever lived. His name is King Solomon. And he said, he who invests, he who gains wealth quickly will watch it dwindle. Mm-hmm. And I think that's kind of a similar thing. We need to be in it for the long haul. We need to be in this investing game like Buffett, looking when his stock in 1974 was, Berkshire Hathaway went from $94 a share down to $40. He was buying more, and he had friends who were selling. Like, okay, when Geico went from $60 a share down to $2 a share, he bought all he could because he saw the long-term prospects in it. Geico, Berkshire Hathaway, they're kind of boring, but guess what? They made him one of the wealthiest men in history. And so that's kind of my last nugget.
Nice. I definitely appreciate those nuggets. And people that want to reach out to you, what's the best way for them to do that?
They can go to our website. It's wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com.
Awesome. We'll have those links in the show notes as well. But thank you so much again, Paul. I appreciate you. I hope you have a phenomenal rest of the day.
Thanks, Gresham. Appreciate it.
All right. And I'll cut it off here. All right, Paul, I truly appreciate you again for taking some time out. We just had a great interview, but I know we touched on some things during the actual podcast that I wanted to do a deeper dive on. I know you had a specific topic that you wanted to kind of touch on and drill a little bit deeper on, so I wanted to kind of give you the mic, so to speak.
Yeah, you bet. So I want to talk briefly about the power of the commercial real estate value formula. And what I mean by that is that owning commercial real estate has within itself a power that you can't easily get if you don't own commercial real estate. That kind of sounds simplistic, but what I mean by this is you can value your cash flow, which is great. Let's say you're making $2,000 a month from the cash flow from a commercial real estate project, but the value of the cash flow is more important. And what I mean by this is this. The value of the cash flow is the long-term wealth you're building with your cash flow. Now, and almost everybody knows this, if you are Chip and Joanna Gaines Jr. and you can fix up your house, let's say you live in a suburb of DC and you buy a house for $500,000 and you finish the basement, you build out the attic, you add on an addition, you put in the most chrome or gold-plated fixtures, and you get, you put $1.2 million into that house. Mm-hmm. Well, and all the listeners know, you might not get $1.2 million out of it if every other house in that neighborhood sells for $400,000, because the value of the property is based on the comps, the comparables. Okay. In commercial real estate, it's completely different. The value of the real estate in commercial is a formula, and it goes like this. It's value equals income divided by rate of return. Okay, and dialing in on that a little bit more, the value of the property is the net operating income, the NOI, divided by the capitalization rate, or it's also known as the cap rate. And that's the general rate of return for an asset like that in your market at this time in history. And so it used to be that the cap rates would run typically 8 or 9%. That's what people expected to get in rate of return. But commercial real estate, fortunately or unfortunately, has become so popular that the cap rates have shrunk down to a lower number, sometimes 5, 6, 7%, sometimes even less. The lower the cap rate, because that's the denominator in the formula, the lower the cap rate, the higher the value of the property. Investors are willing to take a lower return to buy that, okay? So, again, value is income divided by cap rate. If I can increase the net operating income, which is the numerator, and there's many ways to do that, or decrease or compress the cap rate, which is a denominator, and there are a few ways to do that, then I can dramatically increase the value of the asset. I'm going to give you a quick example.
Okay.
So now this, I want to be really, really clear. This is a mobile home park that we invested in, but we have not sold it yet. It's not gone full cycle. And so it might end up, in fact, results will vary. I'm telling you, this is the estimated results of what could happen if this goes like we plan. And I want to say that for, disclosure purposes, that we're not saying this has actually happened. We're saying it's in process. Okay. But to put this in really round numbers, let's say we paid, let's say the property, the mobile home park was $5 million. Now, $5 million mobile home park, let's say we took 60% leverage on it. So that would be a loan to value of 60%. That means the debt was $3 million, and that leaves $2 million in cash that had to be put in by investors. That's called equity. So $3 million debt, $2 million in equity on a $5 million mobile home park. Now, when the new owners got in, that's the operator we partnered with, they looked around and they said, there's a lot of, work trailers and boats and RVs. And a lot of these mobile homes have a third or fourth or fifth or sixth car parked in front of them. And we don't like that. So we're going to clean this place up. And so what they did is they paved an acre of vacant land that had no other use in the front of the mobile home park. And they said, hey, we're going to pave this. We're putting a beautiful fence around it, a locked gate with a code. Everybody that has an extra car or a boat or RV or work trailer has to park it in here. And by the way, we're going to charge you for that. And when they fill that up, when they get all that, that whole area full with the people from the mobile home park, I should say, then any spaces that are left over, they're going to lease those to the public, like they'll put it on Craigslist or whatever as boat and RV storage. Now, it cost them $100,000 to pave and fence this acre, okay? When this is fully leased up, which will take a couple years, but when it's fully leased up, it'll be leasing for $10,000 a month. $10,000 a month is obviously $120,000 a year. That's 120% annual return on investment. Okay, so the value of the cash flow is really good, 120% annual ROI. But the value, when you look at the value of the asset, is much more powerful. That's why I'm talking about valuing the cash flow, not just the value of the cash flow. Okay, so $120,000 in extra income. Remember our formula. The value is the income divided by the cap rate. So extra income, $120,000 divided by an average cap rate of 6%. That's 0.06. 120,000 by 6% is $2 million added to the value of the property. Remember, they only paid $5 million for it, so $2 million additional is a 40% increase to the value of the asset just by making that one change. That's really powerful, Gresh, but it's better than that because remember, there was $3 million in debt and only $2 million in equity up front. Well, all this new $2 million in value didn't go to the bank. It went to the equity holders. Therefore, the equity just doubled in value from $2 million to $4 million. all from this one simple change. And again, this is theoretical at this point because they haven't sold the property yet.
Right.
But they just double the value of the equity on paper, at least. And that was from one change. There's dozens of other things they can do. They can buy carports and rent those out to people, and they do that. They can raise the rent on the different mobile home lots if they're under the market rent. If they're under the market value, they can raise the rent a little bit. They can buy storage sheds and rent those out to the residents. There's all kinds of other things they can do to raise the income and then multiply the value to the equity investors. So this value formula is one of the most powerful things about commercial real estate, and what makes it, really much more powerful than buying and beating your head against the wall to find the next house to flip, or building a small single family home portfolio, which all kinds of people since the advent of HGTV have wanted to do. But they will find, if they look hard, they'll find that commercial real estate is a much more powerful way to build wealth.
That makes perfect sense. And it kind of sounds like a lot of it is just because I guess there's a lower cap, like you mentioned, because of the comps. It doesn't matter if you put in a new kitchen or add a deck or whatever on, you still are kind of at, I guess, based on the comps. The comps will determine how high, your value of that potential property is. But with commercial, you have a lot more kind of ceiling, I guess you can say, so that you can generate more revenue because you can do so many more things to the actual property itself.
Yeah, because the buyer of a commercial property is not just buying a piece of property, but they're actually buying a cash flow stream. And that's one of the things that makes it very different.
That's huge. That's huge. Well, I appreciate you so much again, Paul, for sharing that with us. Just again, for people that might just be listening to this, what's the best way for them to get a hold of you if they want and have any questions or anything?
Yeah, they can reach me at wellingscapital.com. That's WELLINGS, capital CAPITAL, wellingscapital.com.
Awesome. We'll make sure to have that link in the show notes as well, so you can listen to his podcast and all the awesome things that he's doing. But I appreciate you again, Paul, and I hope you have a great rest of the day.
Thanks, Gresh. Appreciate it, man. Take care.
You too.